Moving on to the United States, one of the things that we are looking at is the discrepancy between gross domestic product and gross domestic income. And it explains why there is such high level of discontent among the US citizens. Let's look at this graph. In this graph, what we can see is that the gross domestic income is in recession, while the gross domestic product is allegedly growing very fast. Why? Massive accumulation of debt, massive deficit spending. Massive deficit spending in a growing economy is a hugely dangerous policy, and it shows why there is such a high level of discontent. Citizens are perceiving a recession. The government is telling you it's a strong economy. It's not. Let's go to the next graph, which will show us why I believe that it's very difficult for the Federal Reserve to increase their probability of rate cuts. If we look at the latest figures of the Fed statement sentiment, what we see, thanks to Bloomberg Intelligence, is that sentiment in terms of rate cuts has been diminishing, and sentiment in terms of hawkish policies has been increasing. Therefore, in general, the statements of the Federal Reserve are actually more to wait and see, not to cut rates. And the longer it takes for the Federal Reserve to cut rates, the worse it'll be, for a very simple reason, because in the middle of an election, they're not going to be able to cut rates as aggressively. More importantly, if they cut rates, deficit spending and government spending are going to soar yet again in a very dangerous $2 trillion deficit situation. Let's go to the next graph, which shows us that the contribution to the PCE index, the personal consumption expenditures, shows this, which is the favorite gauge of inflation of the Federal Reserve, which is showing us is that the element that has been helping the inflation to come down a little bit in the last months has basically stopped. And what we see is that all of those elements remain very, very persistent. As such, it is very difficult for the Federal Reserve to take action with such persistent levels of inflation above their target. Let's go to the next graph, which is showing us the contributions to US Consumer Price Index. And this is absolutely critical. The main element that has helped this inflation in the March to December period has been energy. However, oil prices are recovering. We have seen it so far in the year. And at the same time, the energy component is giving a smaller positive impact on CPI, while at the same time, core services remain extremely elevated and in some cases rising. Therefore, there are no elements in the US CPI that suggest an immediate rate cut. Let's go to the next graph, which shows a very important factor as well. This is what the market is expecting out of rate cuts. What has the market done in the last month and a half? Gradually move its moment of rate cuts from January to February to March, and now most of the analysts are expecting the first rate cut in June. In June. Is it possible that that is prolonged and delayed further? Very likely with the previous figures that we have looked. But what I find interesting about this is that the market is expecting that the Federal Reserve will undertake massive rate cuts in the middle of an election process, in the middle of the campaign. I cannot see that happening. I cannot see how the Republicans would accept the Federal Reserve making massive rate cuts in the middle of an election, which would suggest, obviously, that the Federal Reserve is taking actions to support the incumbent. That doesn't make any sense. It doesn't make any sense even with the aggregated figures of GDP and with the aggregated figures of inflation, is that neither GDP, neither employment, neither inflation suggest these rate cuts. But the difference and the widening difference between the economic reality and the aggregate figures also show us why there is such level of discontent. And if we look at the final figure, it tells us why there is such high level of discontent. This, courtesy of Bloomberg as well, shows us what are the main drivers of the GDP, of the gross domestic product of the United States quarter on quarter. And if we look at it, what we see is that 1, government consumption, and 2, change in private inventories have been a significant driver of the surprise in growth. So much higher government spending, which is financed with higher deficits, which means more debt, which means less growth, more taxes, and more inflation in the future. But the change in private inventories is always a contentious issue for a very simple reason. Those inventories are building up in storage by companies at a higher price. That doesn't mean that they're sold. It may be that they have to either reduce the price or that they don't sell those inventories. We need to look at it in detail in the next few months. So, why do we think that there is such high level of discrepancy, and why do we think that there is such a high level of discontent in the United States economy? Because the aggregate figures show that everything is going swimmingly, and the more detailed figures show that things are not going that well. But neither tells us that we will see massive rate cuts in 2024. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.